Well, now let's get more insight from Georg Grodzki. He is Global Head of Credit Research at Legal General Investment Management, and I'm delighted to say he joins me now. Thank you for coming in to look at this. We just heard that Spanish yield. It's pretty high, isn't it? 4.54% for 5-year. What does that tell us about the appetite for Spanish debt and the risk, indeed?
It's all relative, as always, and it's certainly higher than it was in November, but it's not as high as it was a few days ago. In the circumstances, I think the Spaniards will be quite pleased that they got it away with a very high bid cover ratio of 2.1, which is impressive, which bodes well for future auctions. And yes, the concession they had to make on the yield front is probably acceptable in the overall circumstances, given that only a few days ago it looked as if they could fail.
Now, we've also seen Portugal with a fairly successful bond sale yesterday. We're hearing that that was pretty well managed, and it also came with some positive news ahead of it.
Yes, Portugal was very skillful in providing the market with some advance information on their deficit reduction progress, which was better than expected. That clearly helped, assuming it is correct. We also were cheered, if you want so, by Japan announcing that they will support Spanish and other peripheral European countries' bond sales. And the Portuguese head of the EU Commission, Mr. Barroso, was fueling talk that the ESSF may be increased, which may or may not happen in February, but certainly that backdrop all combined to a very favorable auction.
So what does this do? Does this actually lift the pressure off Portugal and indeed Spain, or is it just a short-term sticking plaster? Definitely
the latter. We still haven't won the war, so to say. We may have won this small battle, but there are more to come. There will be big debt maturities for both countries, Portugal and Spain, later in the first half, and these will be the real asset test for the market's willingness to continue to fund these countries on their own credit.
And of course, it doesn't really get us away from the fact that if they're paying these kind of yields, it's very difficult to work out how the economy grows, particularly in Portugal, where growth has been very, very sluggish.
Definitely, yields have moved up closer to a danger zone. There is only so much interest rate which a country can afford to pay without going bankrupt. These ratios can be calculated as a percentage of interest cost or interest spending in total tax revenues, and we have to watch it very carefully. Spain is actually looking quite comfortable in that regard because their debt stock is relatively low. Portugal is a slightly different story. So therefore, yes, any further increase in yield would be very painful and could raise the question again, will they need support from other countries, including, of course, the IMF and the ESFS.
Now, if we look at the Spanish banks particularly, they've got more than 300 billion euros of debt coming due in the next 4 months. It's going to be difficult, is it, for them to raise money again without it being at a perilous rate?
Absolutely. We have already seen a number of Spanish bank-covered bond sales a few days ago, and they came at very punitive cost to these banks, and those costs, of course, raise questions about the viability and the sustainability of their profitability and business model. It remains to be seen, but clearly the Spanish problem is much more a bank problem than it is a fiscal debt load problem, as it was in the case of Greece.
Mr. Zapatero clearly wants some of these CAJAs to merge, and he's talking about more stress tests. Is merger the way forward? Is that going to help Spain's problem?
Well, certainly the banking system has to shrink. It has had become far too bloated as a result of the property lending bubble, and therefore shrinkage is the way forward. And he has been trying hard and struggling to do so because of the resistance from local politicians. So he's talking tough, and he will have to act very tough, and he may even have to consider some forced closures of these banks because they're not viable. At least a great deal. Some of them are not viable. Some need massive support, and continuing to run them as independent organizations just wouldn't make sense.
Okay, Mr. Grodzki, thank you very much indeed for joining us today.
Thank you.